Most people assume you need millions of dollars in the bank to retire on passive income. But the truth is you can build a reliable four-figure monthly paycheck with a surprisingly manageable portfolio. I am going to show you exactly how to generate $1,000 a month using just 3 specific tickers. We are not talking about risky day trading or speculating on volatile crypto coins that crash overnight. This strategy focuses on high-quality income vehicles that pay you cold, hard cash every single month. If you set this up correctly, your dividends will hit your account whether the market goes up or down. The goal of this video is to give you a complete blueprint to replace a portion of your salary with asset income. The first stock on our list is practically legendary in the income investing community for its consistency. It is widely known as the monthly dividend company because it has trademarked that actual phrase. I am talking about Realty Income Corporation, which trades under the ticker symbol O on the New York Stock Exchange. Realty Income is a real estate investment trust that owns thousands of commercial properties across the U.S. Investing in a REIT is one of the easiest ways to become a real estate landlord without any of the headaches. You do not have to fix leaky toilets or chase tenants for rent checks because the company does it for you. They use a triple net lease model, meaning tenants pay for property taxes, insurance, and maintenance. This structure shields the company from rising operating costs that usually eat into real estate profits. Realty Income is a dividend aristocrat, having raised their dividend for more than 25 consecutive years. Right now, the stock typically offers a dividend yield in the range of 5 to 6% annually. While this is not the highest yield on the market, it is considered one of the safest due to their massive scale. Now, let's move to the second stock, which is designed to supercharge your portfolio with a much higher yield. This company operates in the financial sector and is structured as a business development company, or BDC. The stock is Ares Capital Corporation, trading under the ticker ARCC, and it is the largest BDC by market cap. Business development companies were created by Congress to help small and medium-sized businesses grow. Traditional banks often refuse to lend money to smaller private companies because they view them as too risky. That is where Ares Capital steps in to provide the necessary capital in exchange for high interest rates. Because they take on more risk by lending to these companies, they can charge significantly higher interest. The law requires BDCs to distribute at least 90% of their taxable income to shareholders annually. This pass-through structure means they pay zero corporate income tax as long as they follow the rules. The result is a massive dividend yield for you, often ranging between 9 and 10% in recent years. One of the best features of Ares Capital is that most of their loans have floating interest rates. This means that when the Federal Reserve raises interest rates, the interest Ares collects also goes up. The third investment on our list is not a single stock, but a highly popular exchange-traded fund. This ETF has taken the investing world by storm because it combines income with lower volatility. I am talking about the JP Morgan Equity Premium Income ETF, known by the ticker symbol JEPI. JEPI is an actively managed fund that seeks to deliver monthly income by investing in defensive stocks. It holds a portfolio of blue-chip U.S. companies that are generally less volatile than the overall market. But the secret sauce of JEPI is how it generates extra income using a strategy called covered calls. The fund managers sell equity-linked notes, which essentially act like call options on the S&P 500 index. When you sell an option, you collect a cash premium upfront, which is then paid out to investors as dividends. JEPI typically targets a yield of 7 to 10%, though the exact amount fluctuates every month. This strategy creates a nice psychological hedge because you often get paid more when the market is volatile. The main downside is that the covered call strategy caps your potential upside during a massive bull run. Now that we have our 3 income generators, let's do the math to hit $1,000 a month. To be conservative, we will estimate the combined average yield of this 3-stock portfolio. If you split your money equally across all 3, your average portfolio yield would be about 7.5%. To generate $1,000 a month, you need $12,000 in annual dividend income. Dividing $12,000 by 0.075 gives us a total required investment of roughly $160,000. I know that $160,000 sounds like a massive mountain of money to climb. But you do not have to deposit that entire amount tomorrow to make this strategy work for you. The beauty of dividend investing is the snowball effect that happens when you reinvest your payouts. If you start with just $10,000 and contribute $500 a month, the growth accelerates. Every month, your dividends buy more shares, which then pay you even more dividends the following month. Let's discuss how to allocate your money between these three assets based on your personal risk tolerance. A balanced approach would be 30% realty income, 30% Aries, and 40% JEPI. This mix gives you the reliability of real estate, the high yield of credit, and the defensive nature of options. It is also critical to understand the tax implications of this specific income portfolio. REITs and BDCs are legally required to pass their tax burden onto you, the shareholder. This means their dividends are taxed at your ordinary income tax rate, which can be quite high. Therefore, the most efficient place to build this portfolio is inside a Roth IRA or a traditional IRA. In a Roth IRA, all that dividend income accumulates tax-free, and you pay zero taxes when you withdraw. This can save you thousands of dollars a year and significantly speed up your compounding timeline. Realty income, Aries Capital, and JEPI are generally considered high quality, but no stock is risk-free. You should eventually expand your portfolio to include other sectors like utilities to add more safety. But to start, this three-fund portfolio is powerful because it is simple to manage and easy to understand. You do not need to spend hours every day reading financial news or analyzing complicated charts. You just buy the shares, turn on the dividend reinvestment plan, and let the system work for you. That feeling of financial freedom is addictive and will motivate you to save even more money. The path to $1,000 a month is not a get-rich-quick scheme. It is a get-rich-for-sure plan. I want to hear from you in the comments about which of these three stocks you like the most. Make sure to subscribe to the channel so you do not miss our next deep dive into dividend ETFs. Thanks for watching, and I will see you in the next video with more strategies to build your wealth.